Welcome to the Global View on this Friday morning. We are nearing the end of a trading week that has been, by all accounts, extraordinary. Not just because of the market moves that we've seen in equities, but what's been happening in bond markets. We had gold hitting yet another record high overnight. So that face ripped off rally that we saw coming through on, Wednesday here. Now I'm getting confused. So that would have been Wednesday in the United States. Really did give it all back on the Thursday. Well, perhaps not all of it, but at one point we saw the NASDAQ down by more than 7%. So it did end down by just 4.3%, if I can say it like that. But safe to say that the S&P 500 is still down 7.1% since so-called Liberation Day that took place last week. Doesn't it feel like ages ago? Do you know that U.S. President Donald Trump hasn't even hit 100 days in office yet? Wow, that's something to keep in mind. And we've got... what do you say? 4 more years of this? Almost. Okay, so that's a picture of Wall Street through the overnight period. What does it mean in terms of stocks? Well, think about this. We saw a lot of pressure being placed on the Mag 7. So Meta down by 6.7%. We also saw a lot of pressure being put on the banks. Now, keep in mind that we do have the banks reporting. And it starts tonight really with JP Morgan. And so we're watching the banks as well. And some of those big asset managers in the US also got hit very hard. So take a look at KKR and Blackstone and the like. And then we also consider what's been happening in commodities. So if we take a look at downgrades coming through for some of these big base metal plays in the United States. That sets us up for perhaps some big falls here as well. And energy. So we've got Devon Energy, for example, off by about 11%. We saw oil prices snapping back, so giving up all the previous session's gains. So do you get a sense now about just how volatile it is? Even good news like this. So we saw a gauge of consumer inflation, so prices unexpectedly edging lower in March, the first time in 5 years. But this read came ahead of the worst of the tariff announcement. So investors really shrugged off this good news because, of course, the Fed's path is very unclear. A couple speakers overnight, Michelle Bowman, Chicago Fed President Austin Goolsbee, both saying that it's just very uncertain out there around Trump's trade policies. I mean, yeah, we get that. We also heard from Federal Reserve Bank of Boston President Susan Collins, who said that the tariffs will almost certainly drive inflation higher and depress growth, at least in the near term, but also saying that monetary policy is well positioned to respond. Look, just on the trade front, so the EU has delayed retaliatory levies on American goods. But China is vowing to follow through to the end if the U.S. does not let up. China's a watching brief through this Asian session for obvious reasons. Now, we also heard from Michelle Bullock overnight, the governor of the RBA. She said that it's still too early to decide on the path for rates here and that the bank will remain patient as it assesses the economic impact of U.S. trade policy. Again, she was saying that Australia's financial system is well placed to absorb those shocks from abroad. A little bit of stabilization in the bond market through the overnight period. The 10-year yield rose by 3 basis points to 4.42%. Treasury actually sold $22 billion of 30-year notes at a yield of 4.81%. The Australian dollar extended gains to around 62 US, the US dollar coming under pressure, even, if you consider that it's considered a safe haven. And Bitcoin down below that 80,000 US level. Very quickly on commodities, I mentioned oil. There's the picture. Gold jumped nearly 3% to an all-time high. Iron ore, though, it also moved higher, but it does remain below that $100 mark. Let's get some perspective. I don't think it needs more of an introduction than that. Sam Ruiz from T Rowe Price is joining me now. Sam, welcome. Nice to see you.
Good morning.
Is there anything in your view that justifies the action that's being taken by the U.S. administration in terms of tariffs or the manner in which they've unleashed this on global markets?
I think it depends who you ask about that. So I think the US would say this is entirely justified because of the deficits that the US has, and they would argue that there's just been too many decades gone where they've shipped off cheap labour externally, and other countries might have benefited the US more initially by being that real cheap, low value add source of manufacturing, whereas now they've really jumped ahead further and are actually stealing more from the US than what they anticipated and coming up the value chain to even start to compete with the US. So I think the US feels entirely justified. The problem is we all sit here in the peripheral countries and maybe some people in the US and say, things felt pretty good because we were all friends. There was this sort of great allyship. Global trade has been knocked a little bit in the last sort of 8 years or so, but things were pretty streamlined. So I think the rest of us are saying, please don't do anything. But I do think internally some people in the US, definitely Trump, believe that this is justified and something that's necessary, sort of this sort of short-term pain for the longer-term benefit of the US economy.
But his plan is very unclear. He's obviously flip-flopped. He blinked in the face of bond market vigilantes the other day. What is your base case? So is there a US recession? Is there a global recession? Because that will dictate what you do, in terms of asset allocation.
Yeah, so the most unhelpful thing in responding to that is we have no idea. And I think there are points in the market where you need to be very humble, where you don't have the cards to pivot decisively on any, the base case percentage. Everyone can have one, but if your base case is like we could ascribe a 10% chance of that, it's really not valuable at all. So if we step back, the volatility we're seeing, which you've already referenced, is because the market's trying to figure out, is this all a negotiation ploy? And really they're trying to just walk it all back, but maybe the US gained a little bit of ground? Or is Trump determined to be known as the president that brought manufacturing and productivity back to the US? Now, the outcomes of either of those are they couldn't be any more different to each other. And that's why in 2 trading days, you had the NASDAQ up, I think it was the second biggest daily rally in history. And then the following day, so overnight in the US, you all of a sudden had the market almost being closed and trigger down. So this is wild. What I'd say is, other than is there a recession or not, definitely we think that growth is going to be slower as a result. The biggest question mark is investors have to now figure out, we've come from elevated optimism. We had the S&P 500 trading at 22 times earnings. Now it's down to around 19 times. Earnings haven't really been sort of pulled down too much yet. So you have to really figure out, is this a blip and the multiple's fair now and earnings won't come down too much? Or maybe there could be this sort of 15 to 20% retracement lower as the market starts to price that in even further.
So what's your gut feel?
Our gut feel is there's really 2 scenarios we think about. We think that this is a negotiation tactic of Trump's, or he is really determined that this is the new way for the US. Now, that can then be split on each scenario. On the first side, if this is a negotiation tactic, unfortunately, we think now there's an increasingly slim chance that they can pull it all back and sort of go back to this great narrative of everything growing and everything's fine. Mm-hmm. Effectively, we think that the action so far has created so much uncertainty that it's set the cart in motion of this slowdown. You made a comment around we've got banks reporting. I'll give you an example. We're going to see the quarterly earnings come out of the US. The quarterly earnings are probably going to be fine because this impact hasn't really hurt things yet. But the forward guidance and the level of certainty from management is going to be really unclear. If you were someone that was going to hire staff next quarter, if you were going to open a new manufacturing plant, you're probably going to put that on hold. Even though we've gone back to these sort of base level tariffs, nobody knows what Trump effectively would do or if there will be a negotiation. So I think on the forward-looking basis, the slowdown is coming. It's just how bad. The worst case scenario, which I'm reluctant to say is something that we're fully pricing in yet, is that Trump wants to be known. His legacy is going to be one where he says, the tariffs were worth it. We brought things back to the US and things were unsustainable as they were. That will be sort of global Armageddon. And let's just hope it doesn't get there.
Well, we hope it doesn't, but hope is not a plan, right? So what have you been doing there at T Rowe Price when it comes to your portfolios? Do you reckon that, valuations have returned to perhaps something more attractive in the United States? Do you just ditch the US, look towards other geographies like Europe, for example?
Yeah, so definitely other geographies have become more attractive in our view. Relative valuations have been extreme. This global reordering of military and where fiscal spend will happen in the future in places like Germany just makes some of those markets more attractive versus the US. But overall, I'd say when things are so uncertain, our bias is to not play into this, I'd say the muscle memory that the market has developed over recent years of just buy the dip, or the Fed's got your back, or if the market's down 10%, buy it because that's that's always been a great opportunity. We think that there's something more structural potentially happening here that changes the longer term course of how the market works, of the return opportunity from here, of how US has outperformed everything. So our bias is to actually be a bit more defensive. We've been adding to consumer staples, adding to utilities, adding a little bit more to outside US stocks as a result. And to use the industry term of how we clarify risk, our beta of our portfolio, we've been deliberately trying to pull that back for the uncertainty.
Yeah, and just to push the point, because I know we've talked about your tech exposure in the past, when you see Meta down as it was through the overnight session, it's not tempting you to get or allocate more.
No, we've been selling tech. We think that the story, particularly around AI, of there being under capacity of AI infrastructure and computing power, well, the recalibration of the economic sort of activity is probably going to mean we have enough capacity for that. If you bring it back to some of the Magnificent Seven, so if we even bring it around that, but Meta inclusive, what people might not appreciate is that these companies do have very strong balance sheets, they've got very strong free cash flow, but their free cash flow is a derivative of economic health. So if you're Google, if you're Meta, your core revenues are based on the sort of small, medium businesses and enterprises having enough money to put advertising on your platform. And if those businesses are more uncertain, if they think their revenues are declining, or if their revenues do actually decline, they've got less money to spend with Meta. And that free cash flow doesn't just impact the revenue, so the deceleration of that doesn't just impact core revenues. We believe it also impacts their ability to allocate the huge capex we were seeing into the AI ecosystem.
Right.
So both of those are quite negative. And if you then just picked on one particular company, Apple, I mean, Apple, I heard, was flying sort of urgently 1.5 million iPhones from India to the US to avoid the tariff deadline. They are, unless Trump basically says you're excluded, some of these companies, the way that their supply chains operate as well, are severely impacted through Asia.
Yeah, and Chinese sellers saying that they'll either hike prices or abandon Amazon's platform altogether. It's these ripple effects that you've really got to think through as an investor. So with the quarterlies starting really today with the big banks, you're going to be listening acutely, not just for how they see the economy playing out, but also their capex spending going forward as well.
Absolutely, capex spending. I mean, I think it is unquestionable that we're going to see a much more uncertain tone. So it's going to be really trying to read the tea leaves in that. I think what's going to be more important, we just expect guidance and forward-looking commentary to be, who knows, effectively from the big companies. It's then going to become how you start to think about some of the prices of these companies starting to price in the worst case scenario. So if you're a bank, if you're a KKR, if you have private credit or private equity, investors are like, I don't want to wait around and find out how bad your credit gets. But there's going to be a point where that price starts to reflect one of the worst case scenarios, and the opportunity starts to creep in when you're like, if I've got a 2-year view here, the market's already pricing in a recession, I'm buying it in with that priced in, there's the asymmetry of the upside is much better priced in here. So I think we're going to be definitely listening to commentary, but the price action, I don't want to just say we're only sort of defensive. There are opportunities we're finding where companies are starting to get oversold on that pessimism. So we'll definitely be looking at price action strongly.
It's a really fascinating time to be in markets. But just to push the point a little bit, when you are looking across and after this extraordinary week, you are still anticipating this to be a very headline-driven market, so really volatile. Therefore, opportunities throwing themselves up occasionally.
Correct. I mean, I'll give you one stat. There was a day, maybe 2 or 3 days ago, where the entire volume of the US market was driven 42% by ETFs. Now, that's well and truly above the average. And what that's saying is there's a lot of hedge funds out there, fast-moving money, that are trying to get their sort of neutral stance, or they're trying to hedge on the defensive, or make sure they've got enough upside risk if the market's rallying. That just means that even if you have a really strong belief that one of these companies is overpricing the downside case, you have to also think about the way the market works, where there's this huge wall of money working against you. If people are rushing out and it's indiscriminate selling, rushing into that too early, you're still sort of fighting the tide too much. So it is a terrible thing of, like, it's clear as mud, basically, where I'm saying nobody really knows right now. It is something for us. We have the benefit of having a 2 to 3 year horizon, managing a much more diversified portfolio. So it's not going to help saying we think this stock's undervalued, buy. Yeah. But I would just say investors really need to be cautious about having too definitive a view. There's a lot more water that needs to go under the bridge. So if you've got a long-term view, there'll be great opportunities. In the short term, be wary of just saying market's down a little bit, buy because it's always gone up.
Yeah. Sam, thank you so much. We're out of time. Really appreciate your insights.
Great
Sam
to be
Ruiz
back.
from T Rowe Price. We are expecting to see this local market down by 1.5% when trade begins now. So we'll wrap it up here and I'll take you through the open next.